Hi, this is Tron Welch with Welch Financial Planning, and we're going to go through our 2023 third quarter investment update. We just did the economic update a couple days ago, and this will be a fairly short presentation. The economy kind of doing its thing, and I will say the investment world is kind of doing its thing. There's not too many shockers out there, and so we'll just go through some highlights and some things that I find interesting. So let's start where we are in overall returns. This chart goes back to 1996. And it just does show the amazing run the stock market's been on since 2009 or so. What I want to look at here is actually where we are today. Even though we've had a really nice run up in 2023, we're still 5% below where we were January 1, 2022. So there is a little bit of room to grow to get back to where we were. So your account balances are probably not the same point that they were, but they're getting closer there. So let's go into the valuation of the stock market. This is the PE ratio chart that we do show probably just about every investment return discussion. And the piece on this is it kind of shows where we are, whether stocks are inexpensive or expensive. And right now it's pretty easy to say that stocks are pretty overvalued, and a little bit of some high values are pretty expensive. This would be kind of a little bit of a tough market, just looking at this chart alone, a tough market to get into due to its overvalue. So it tells us one or two things, that corporate earnings are going to skyrocket, and I'm not sure that we're ready to say that, or maybe the stock market is a little overvalued, and I think that's where we're at. But let's go ahead and go to this next chart, diving a little bit deeper into the data. And I think it brings us some answers that will bring some comfort over where the stock market is expensive-wise. So this is a trend that's been going on for a couple of years, but it's certainly nothing that we've seen in the 50s, 60s, 70s, 80s, 90s, in the early 2000s. But there has been such a concentration in the stock market on the top 10 stocks, and we're kind of learning how to handle that moving forward. So in the upper right-hand corner of this page, you can see the weight of the top 10 stocks in the S&P 500, and you can see it's at 31%. So that means that the top 10 holdings are worth 30% or 31% of the entire index, which means 490 stocks make up the other 2/3 of the index. And so there's a really high concentration, heavy weight in those top 10 stocks. And additionally, these top 10 stocks look really expensive. And you can see that on the left side of this chart in the green. This is again the PE ratios that are going on, that they're at a 29 ratio, while the other 490 are averaging out to about 19, which is a pretty reasonable number and should allow for some growth moving forward. So the large run-up of the stock market that we've seen here has been driven by the top 10 stocks. And we use the term broadening out the market, meaning I would expect as the stock market increases in the second half of the year, or really the last quarter of the year, that we should see the market gains over the other 490 stocks. And I'd be surprised if we saw a lot of jump in the top 10, but I would have said that at the beginning of the year and would have been wrong. So I could be wrong again now, but we should see some additional growth going on the other stocks. It's also increasing the risk when you hold an index that the behavior of those top 10 stocks will have a very large impact on the index. We are not the index holders in here, and so we're going to avoid that risk by the way that we manage money. But for the index holders out there, that may be a concern to you. So just a quick piece over to the corporate earnings, which is a little bit more of an economic piece. But it does impact the investment side here, and we can see the left-hand side, the S&P future earnings per share, and you can see 2024 by the analysts looks like a pretty good year lining up. So if the economy can hold as it is, which I don't see any reason why it won't, because it's just growing at kind of a 2%, which I think it will do for quite a while moving forward, we should have some nice earnings for fourth quarter of 2023 all the way through 24, avoiding a recession, by the way. is a point that we should always bring up again, that we don't see a recession coming. So we should have some, hopefully, less dramatic stock market behavior over the next 12 to 18 months. This will become a welcome relief from what we've seen in the consumer confidence in stock market. So to be clear, the U.S. consumer is really what drives the stock market, drives the economy in the U.S. It's not big business and it's not government driving it. It is us off to Target and Costco and buying cars and all that. The consumer is king in the U.S. economy. And so if you look at this chart, which I think is really interesting, in June of 2022, which was a year ago now, we were lacking confidence. And our confidence was so low, it's actually lower than our confidence in 2008, which seems staggering to me because in 2008 was a really difficult time economically. People were getting laid off left and right, foreclosures were running rampant across the U.S., and none of that's going on right now. In fact, we still have 10 million open jobs looking for people that can fill them. So I'm just a little bit surprised that we are not feeling very confident in today's environment, even though unemployment is at historic lows. Interest rates are climbing, but still well below averages. And then there's jobs for basically anybody who's after it. So I'm not sure why we're not confident, but if that grows moving forward, the stock market should reflect positively to that. This next chart, we're going to flip it around a little bit because this chart I typically use to explain why we don't own bonds and why it's a bad idea to own bonds. But it is a new world right now with the inflation brought the higher interest rates. And the higher interest rates is bringing an opportunity us to reevaluate our position. So my clients and people that attend the classes will know that we haven't owned bonds for 23 years now. But let's look at this chart, and I think we come to a different conclusion on that. So on the right-hand side, it shows us the impact on the bonds of a rise or fall of a 1% change in interest rates. Starting at the top is the 2-year Treasury, that's the TYUST, that's the 2-year Treasury, followed by the 5 and then the 10. The 10 is really what we focus at, and that's a spot kind of where we put our peg on to evaluate the bond market. And you can see on this that the 10-year Treasury, should it fall by 1%, the interest rate fall by 1%, we'll see a 12% windfall on that. That's fantastic and would be really helpful. But the other side of it is that there is a 1% increase in interest rates. The bondholders will see a decline of 4%. So interest rates moving one direction will help you by 12%, and moving the other will only hurt you on 4%. And that feels a little bit out of balance to an extent that I think it's time to get into the bond market. And so you're going to see that in your portfolio, which will be quite a surprise, certainly to me. But I think that day has come where there is some opportunities to build some appreciation off of bonds. So keep an eye on your portfolio for that happening. So moving on to the international valuations slide, and we are continuing to hold international equities. We feel it's a good spot to be. They're really selling at a discount, and this chart on the left really shows that. So the PE ratio of our market here is about 19. The international market's at 13. That's a 31%-ish type discount on earnings. And that's just a little bit too large to ignore. And so we do expect that there will be some closing of that moving forward. And as the PE ratios increase internationally from a PE of 13 up to like a 14 or 15, there will be some nice appreciation that will take place, and we want to be in the way of that. So we continue to hold international equities for that reason. The last slide is the asset returns slide. This is also known as the quilt chart. We do show it very often, and you can see across the top is the year that it's discussing, and then as you move down, the best performing asset class is across the top, and then it works its way down to the worst performing asset class of the year. So year to date is 2023. You can see the stock market is up 20%. That's a phenomenal number. Again, let's temper that a little bit by it's really concentrated in 10 stocks is the majority of a lot of that gain. And we expect that the stock market, as it broadens out, that we'll be able to capture some of that. But second place for the year is the developed markets. And so we are, after a long wait, glad to see international stocks are climbing back up, kind of holding a place. And we're capturing some value there to portfolios that are doing well. A well-allocated portfolio, which is kind of a moderately aggressive type portfolio that's built on here, should have you up at about 10.5, close to 11% for the year. So more aggressive investors should be higher than that. More conservative investors should be lower than that. If you have any questions about your portfolio, give a call. Happy to have these discussions. It's always kind of a fun discussion to show people how their money is working for them and the success of their portfolio. So with that, we're going to go ahead and close it down. Again, I'm going to invite you to let me know if you have any questions. Have a great day, and I look forward to seeing you.